In this video, we will reveal our top 7 candlestick patterns, going from basics to advanced patterns. We will also show you how to use these patterns in combination with price action to spot high probability trade opportunities. All in all, this is going to be a candlestick trading masterclass. A quick note before we start. If you are interested in our free training, click the link in the description to know more. It's free. And with that being said, let's get started. What are candlesticks? Candlesticks are just a simple way of looking at the historical price of the asset. Each candlestick represents the price movement of the asset for a particular period of time. So, if we are on a daily chart, a single candle represents the price action for one day. On the chart, we see 2 types of candles: green candles and red candles. A green candle is formed when the closing price is higher than the opening price. This indicates that the buyers were stronger than the sellers. Similarly, a red candle is formed when the closing price is lower than the opening price. It indicates that the sellers were stronger than the buyers. Now, the reason why most traders use candlesticks is because it gives us a better understanding of the price movement. A candlestick consists of 2 parts: the wicks, or shadows, and the body. The end of the upper wick shows us the highest price achieved during that time. Similarly, the end of the lower wick shows us the lowest price achieved during that period. When it comes to the candle body, things start to differ. For green candles, the lower end of the body is the opening price, and the upper end is the closing price. On the red candle, the upper end of the body is the open, and the lower end is the close. Before we move on to the candlestick patterns, we need to understand a few concepts about candlesticks. Concept 1: big versus small body. The body of a particular candle can tell us a lot about the strength or weaknesses of the buyers and sellers. For example, here we have 2 green candles. The candle on the left has a big body and relatively small wicks. The price opened down here. Initially, the sellers tried to push the price down. The sellers were very weak as the buyers quickly came in and took the price higher. Then the buyers were able to travel a lot of distance without any pressure from the sellers. As a result, the price closed very near to the high. This shows us that the buyers were significantly stronger than the sellers during this candle. On the second candle, the story is different. The price opened here, and the buyers started to move the price. They raised the price to a new high, but at the high, the sellers stepped in and took the price downwards. The sellers were powerful and nearly covered the entire distance back to the opening price. But the buyers just about managed to close the price above the open. In this instance, we can see that the buyers were stronger than the sellers, but the difference between their power was insignificant. When the candle's body is relatively bigger than the wicks, it shows that either the buyers or the sellers were in control. On the other hand, when the body is smaller than the wicks, it shows that there was much less control from either side. It was a tough contest between buyers and sellers. Concept 2: large wicks. Whenever we spot a large wick above or below the body, it gives us a strong clue about the price action. If we spot a large wick above the body, it shows us that the sellers are strongly selling on these levels. For the price to move higher, the buyers will need a lot of effort. Similarly, if we spot a large wick below the body, it shows us that the buyers are strongly buying at these lower levels. If the sellers want to move the price lower, they must overcome these buyers. So the concepts of body and wicks are essential moving forward. Keep them in mind as we begin to understand some basic candlestick patterns. If you are enjoying this video so far, then be sure to hit the like button and subscribe to our channel so that you never miss any of our new videos. Basic patterns. Pattern number 1. Bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern. It indicates a potential reversal to the upside. A bullish pin bar consists of 3 elements: a small green body, a large wick below the body, a tiny or no wick above the body. Let's understand the psychology behind this pattern. A bullish pin bar shows that the price opened around this area, and instantly the sellers tried to take the prices down. They were able to push the prices down, but at some point, the lower prices triggered buy orders from the buyers. The buyers were significantly stronger than the sellers as they pushed the price beyond the open. Therefore, if we think about it, the buyers covered more distance than the sellers. It indicates that the buyers have stepped in and they are trying to take the price higher. If a pin bar appears after a strong down move, it indicates that the sellers have lost their strength and the buyers are now stepping in to move the price upwards. To trade the pin bar, we must look at other confluences to confirm our bias. We will discuss that later on, but if we find a buying opportunity as a pin bar, we can place a buy order above the high of the pin bar. We can set our stop loss below the pin bar and target the next resistance. Pattern number 2. Bearish pin bar. The bearish pin bar is just the opposite of the bullish pin bar. It is a red candle with a small body, a large wick above the body, and a tiny or no wick below the body. It indicates a reversal to the downside. The psychology behind the pattern is very simple. The price opened here, and the buyers started to move the markets